Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host. I'm Sandy, your guest host from Keller Williams Legacies here, to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're kicking things off with a rather controversial topic that's been making waves in the Ontario real estate industry. It turns out that many brokerages are pocketing interest on trust account funds that would otherwise be owed to home buyers. This is all due to a loophole in the province's real estate law. Sandy, what are your thoughts on this?
Well, Steve, it's quite an eye-opener. The Trust and Real Estate Services Act in Ontario requires that any interest collected on deposit money held in trust accounts belongs to the owner of the deposit. However, the fine print in these real estate contracts, known as Schedule B disclosures, allows brokerages to include language that either charges high transaction fees or sets a threshold under which the interest won't be paid to the buyer. It's a bit concerning that such practices are under the radar for most consumers.
Exactly, Sandy. And it seems like there's a significant lack of understanding among buyers about their rights in these situations. Stephanie King, the Director of Compliance at RARE Real Estate Inc., pointed out that most people aren't even aware of the Schedule B details. It's a transparency issue, really. What do you think about the potential earnings brokerages could be making from this?
The numbers are quite staggering, Steve. For instance, Right at Home Realty, the largest brokerage in Ontario, reportedly sold over 8,100 homes in a year. If each of those transactions earned a minimum of $150 in interest, the brokerage could have collected $1.2 million in interest earnings. And that's just one example. The Canadian Real Estate Association reported that by the end of October, Ontario had 140,334 home sales worth $117 billion. So, the potential for interest earnings is huge.
The figures are indeed impressive, Sandy. And it's not just Right at Home Realty. Other brokerages like eXp Realty of Canada Inc., Royal LePage Signature Realty Inc., and Harvey Callas Realty Ltd. also have high thresholds or administrative fees, limiting the amount of interest they return to consumers. Cameron Forbes from Re/Max, Realtron Realty Inc., mentioned that these fees are necessary to cover administrative costs, but it's clear that the system might need a bit of an overhaul to ensure fairness.
That's true, Steve. While some brokerages like Re/Max Hallmark Group of companies try to keep fees low, there's still a perception issue. Steve Tabrizi from Hallmark mentioned they don't want to be seen as price gouging, despite the costs involved. It's worth noting that Ontario is one of the few provinces allowing brokerages to keep interest on deposits. Other places, like British Columbia, mandate that such interest be diverted to other uses, which could be a model worth considering here.
Indeed, Sandy. There's a lot at stake here, and it seems like a conversation worth having within the industry. Perhaps mandating interest-free trust accounts might be a solution, but as Cameron Forbes pointed out, the industry believes this money should earn something. It's a complex issue, and I think it's going to be interesting to see how it unfolds and whether regulatory changes will be made to address these concerns.
Our next topic is a big one, and it's about the housing construction in Canada. The Canada Mortgage and Housing Corporation, or CMHC, has come out with some pretty significant numbers. They're suggesting that to regain housing affordability, Canada needs to double its current pace of housing construction. We're talking about building between 430,000 and 480,000 units annually over the next decade. That's quite a leap, Steve.
It sure is, Sandy. The CMHC believes it's possible to achieve this, but not without some major changes. They're saying we need a bigger and more modern workforce, more private investment, and fewer regulations, among other things. Alid Abyorworth, the Deputy Chief Economist for CMHC, highlighted the need for innovation in construction technology and increased labor productivity. It's a tall order, but it seems like it's necessary if we're going to tackle the affordability crisis.
Absolutely, Steve. And it's clear that the CMHC is urging everyone, from policymakers to the private sector, to understand the scale of the challenge. They've been quite vocal about the systemic changes needed to double the pace of home building. But it's not just about building more homes. There's a need to ensure these homes match local incomes. For instance, CMHC noted that Toronto needs a 70% increase in home building despite increased rental construction.
That's right, Sandy. And it's not just Toronto. Vancouver and Montreal are also facing significant housing gaps. Vancouver needs a 29% increase in housing units, while Montreal faces the largest gap among Canada's major metropolitan areas. The cost of home ownership in Montreal has been climbing faster than local incomes, and that's a pattern we've seen since the pandemic. It seems like without a significant increase in supply, these affordability issues are only going to get worse.
And then there's the political angle. Prime Minister Mark Carney has set a target of building up to 500,000 housing units annually across the country. But there are doubts about whether the government can meet these ambitious targets. The Toronto Dominion Bank recently questioned the feasibility of these goals, suggesting that even 400,000 new units would require a massive boost in productivity. They call it a revolution in completions.
Indeed, Sandy. The government is looking at policy changes to boost supply, like cutting the goods and services tax on new homes and lowering development charges. But TD Bank is skeptical, arguing these measures might not be enough. They emphasize the need for an unprecedented boost in productivity to meet these targets. It's a challenging situation, but if the right steps are taken, it could lead to significant improvements in housing affordability.
Our next topic is the Bank of Canada's recent decision to hold the overnight lending rate steady at 2.75%. This move has left both commercial property professionals and consumers in a bit of a wait-and-see mode. The Bank of Canada has already cut its rate by 225 basis points since last year, making it one of the lowest in the world. But despite hopes for further cuts, the central bank decided to keep things unchanged for now. Steve, what's your take on this decision?
Well, Sandy, it's a complex situation. The central bank cited ongoing uncertainties and pressures on inflation as reasons for maintaining the rate. They're being cautious, especially with the current economic landscape. It's understandable, given the unpredictability in global trade and the pressures from tariffs imposed by the United States. These factors are impacting Canadian exports and could affect inflation and household spending.
That's true, Steve. Many in the real estate industry were hoping for more rate cuts to spur new housing construction. Mark Feeder, president of Avison Young Canada, mentioned that the industry has been dealing with uncertainty, not just in real estate, but across the economy. He seemed to suggest that the central bank is taking its time to assess the volatility before making any further cuts. What do you think about that approach?
It makes sense, Sandy. While some industry professionals like Feeder are hopeful for a rate cut in September, the Bank of Canada appears to be waiting for a clearer picture of the tariff impacts and other economic indicators. Governor Tiff Macklem acknowledged the unpredictability of U.S. tariffs, which complicates any single forecast for the Canadian economy. However, the central bank is preparing for multiple scenarios to address these uncertainties.
And it seems consumers are feeling the pressure too. According to a survey by MNP, 2 out of 3 Canadians feel they desperately need a rate drop. Inflation increased to 1.9% in June, which is adding to the financial strain many households are experiencing. The survey highlighted that Canadians haven't felt such economic uncertainty since the COVID-19 pandemic. Steve, do you think the central bank's cautious approach is justified given these consumer concerns?
It's a tough call, Sandy. On one hand, there's a clear need for support to ease financial pressures on consumers. On the other, the central bank needs to ensure that any rate cuts are sustainable and won't lead to further inflationary pressures. Andrew Grantham from CIBC noted that the bank might consider more cuts in the future, but they're not ready to commit just yet. It seems like they're closely monitoring upcoming data to make informed decisions.
Indeed, Steve. The hope is that by the next meeting in September, the Bank of Canada will have a better understanding of the economic situation. Feeder mentioned that a rate cut could bring more movement in sectors like industrial, multifamily, and office real estate. It's a waiting game for now, but the potential for a rate cut later this year could bring some much-needed relief to the market. Our next topic is a deep dive into a significant issue affecting the housing market in Canada, and that's the weak productivity in residential construction. The Canada Mortgage and Housing Corporation, or CMHC, has recently released an analysis showing how this weak productivity is a major driver of rising housing costs.
That's right, Sandy. Since the pandemic, weakened productivity has added an estimated $6 to $8 billion to construction costs. According to CMHC, this accounts for up to 20% of the increase in new home prices. It's a staggering figure that really highlights the importance of efficiency in this sector.
Absolutely, Steve. Aladab Yorworth, the deputy chief economist for CMHC, emphasized that productivity is critical, especially in residential construction, where Canada's challenges are most acute. The report, titled Framework for Change: Productivity in Housing Construction, examines how this downturn in productivity is slowing the pace of new housing starts.
And the report doesn't just stop at identifying the problem. It outlines why improving efficiency through modern tools and technologies is essential. It even draws lessons from other countries that have modernized their construction sectors through digital standards, innovation incentives, and streamlined regulation. This could be a roadmap for us here in Canada.
It's an important point, Steve. The industry has a key role to play, but governments can support progress by establishing effective and long-term policies to make it easier to build homes. It's a collaborative effort that's needed to tackle this issue head-on.
Yes, Sandy. And as Alayda Bjorworth mentioned, the challenges in residential construction are where Canada's needs are most pressing. By adopting some of the strategies outlined in the report, such as embracing digital standards and innovation incentives, we could potentially see significant improvements in productivity.
It's clear that to address the housing supply and affordability crisis, we need to focus on productivity improvements. The CMHC's analysis provides a valuable framework for change, and hopefully, it will prompt both industry and government action. The need for modern tools and technologies is more urgent than ever. Today, we're diving into the impact of Bill 60 on Ontario's housing market. Passed just recently, this sweeping omnibus bill aims to accelerate housing supply and reform the province's rental market infrastructure. Housing Minister Rob Flack sees these changes as essential to restoring market balance. He believes that increasing supply will naturally lead to lower rents. It's a bold move, but what are the specifics, Steve?
Bill 60 targets several bottlenecks that have long plagued the housing market. It aims to speed up processes by accelerating hearings at the Landlord and Tenant Board, standardizing development charges across municipalities, and streamlining zoning approvals. For instance, landlords can now evict tenants for non-payment of rent after just 7 days' notice, down from the previous 15 days. Additionally, for personal use evictions, landlords providing 120 days' notice won't need to compensate tenants or offer alternative housing. The appeal period for eviction orders has also been reduced from 30 days to 15.
That's quite a shift, Steve. The Real Estate Board of Greater Toronto Area, or TRREB, has welcomed these changes, highlighting how they could target systemic delays and improve procedures for rent arrears. Alekia Berry-Spruill, TRREB's president, mentioned that Bill 60 would place greater emphasis on reducing delays at the Landlord and Tenant Board. It seems like a move that could streamline the process, but there are concerns too.
Absolutely, Sandy. While the bill focuses on removing barriers to housing supply and clarifying development charge calculations, there are criticisms as well. Critics argue that the changes could make evictions easier, potentially stripping renters of vital protections. Tenant advocates worry that the accelerated timelines and compressed appeal periods could exacerbate homelessness, especially during this affordability crisis.
It's a valid concern, Steve. Even though Housing Minister Rob Flack positions Bill 60 as a fix for housing affordability, TRREB has noted that this legislation alone isn't a silver bullet. They're calling for continued provincial and federal action on broader measures like harmonized sales tax rebates for all new construction. It seems like a comprehensive approach is needed to truly address the challenges in Ontario's housing market.
Indeed, Sandy. While Bill 60 is a step in the right direction for some, it's clear that more needs to be done to achieve lasting affordability and stability in the housing market. The focus on supply-side solutions is crucial, but it has to be part of a broader strategy that also considers tenant protections and affordability measures. It'll be interesting to see how these changes play out in the coming months and whether they'll lead to the intended outcomes.
The Toronto real estate market is seeing a shift in buyer behavior as they continue to search for bargains. The Teranet National Bank House Price Index for Toronto dropped 7.2% in October compared to the same month last year. This trend has led to a more pragmatic approach among buyers and sellers.
That's right, Sandy. John Pasalis, the broker and president of Realosophy Realty, has observed a notable change in seller sentiment. He notes that sellers have become more businesslike, resulting in a gradual erosion of prices. He's estimating that the average price in the Greater Toronto Area is set to end the year 7 or 8% lower than last year's average.
It's interesting how the market has shifted. At the start of the year, there was a lot of optimism fueled by lower borrowing costs and a dip in inflation. But now, with the return of Donald Trump to the U.S. presidency and his stance on trade, there's been a lot of anxiety affecting both buyer and seller sentiments.
Yes, Sandy. Buyers initially rushed into the market expecting prices to rise, but instead, they've seen a downturn. The National Bank of Canada economists have pointed out that seasonally adjusted sales in October were 12.4% below the recent peak from last year. Despite some rebound since March, the affordability challenge remains a significant hurdle.
Even with these challenges, there are still opportunities. Pasalis mentions that the most appealing houses in central Toronto are still receiving multiple offers, though these bidding wars are becoming rarer. Buyers are cautious and often submit lower offers, especially on properties that aren't staged or polished.
And it seems like sellers, especially in the condo market, are feeling the fatigue. Many are opting to start with lower asking prices to undercut competition. This is particularly true for those who bought properties as investments and are now looking to cash out.
It's a strategic move, Steve. Sellers are often willing to accept lower offers just to close a deal and move on. This dynamic is also influencing the freehold segment, with buyers finding more value in areas like Richmond Hill and Markham, which weren't as accessible a year ago.
Indeed, Sandy. Although some buyers are cautious about further price declines, there are those who are ready to move forward without waiting for the perfect timing. With prices dipping, buyers with budgets of $800,000 to $900,000 can now find comfortable options in the city.
Max Canada is forecasting a promising outlook for the housing market in 2026, predicting a 3.4% increase in national home sales. This comes after a year marked by economic fluctuations and uncertainties that impacted the real estate sector. According to the Max Canada president, Don Kotick, there's light at the end of the tunnel as Canadians continue to show a resilient interest in home ownership despite the challenges.
That's right, Sandy. The report highlights that 1 in 10 Canadians plan to purchase a home in the next 12 months, with half of these being first-time buyers. This renewed interest is largely fueled by the built-up inventory and a 21% increase in new listings across Ontario, contributing to more balanced market conditions. This setup is encouraging for potential buyers who have been waiting for a more favorable market.
It's encouraging to see this kind of optimism, Steve. The report also notes that home sales had fallen year over year in 32 out of 38 markets analyzed between January and October. But with the inventory increase, average prices are expected to drop by 3.7% in 2026, which might be just what buyers need to jump back into the market.
Indeed, Sandy. The resilience of the Canadian homebuyer is quite remarkable. Max's outlook suggests that first-time buyers are finding creative ways to save and enter the market, which could significantly drive sales. This shift, could provide the momentum needed to counteract the declines seen in 2025.
Absolutely, Steve. And while the economic clouds have loomed over the real estate market, it's clear that Canadians are still dedicated to achieving homeownership. The increase in inventory and the subsequent price drops are certainly playing a role in this renewed motivation.
It's important to note, Sandy, that while this forecast is optimistic, there are still challenges that need addressing. Economic conditions can shift, and the market needs to remain adaptable. However, with the current trends, it seems like the housing market could indeed see a rebound in 2026, provided these conditions hold steady.
That's a great point, Steve. The market's adaptability will be crucial, especially if economic conditions change. But for now, the outlook is positive, and it's a relief to see some potential stabilization on the horizon for the housing sector. Let's dive into the insights from Lindsay Smith, a seasoned real estate broker with nearly 4 decades of experience. He's shared some valuable perspectives on pricing strategies for home sales, which are particularly pertinent in today's balanced market.
Absolutely, Sandy. Lindsay highlights a crucial point. The art of pricing a home is less about hitting an exact number and more about understanding the market dynamics. He emphasizes that underpricing a home is rare because buyers tend to correct undervaluations quickly through multiple offers.
That's right, Steve. Lindsay stresses that overpricing is the real danger. Homes that are priced too high tend to linger on the market, gathering dust instead of generating excitement. He calls overpricing a silent assassin because it doesn't attract buyers, leading to a stale listing.
Exactly, Sandy. According to Lindsay, proper pricing isn't a mystery. It requires looking at recent sales, current competition, and market shifts. He cautions against using outdated data, which can lead to homes languishing as expired listings.
Lindsay also provides a practical example from the Durham region, where homes sold for about 98% of their asking price last month, taking an average of 47 days on the market. This indicates that buyers are negotiating again, a shift from the frenzied market of 2021.
That's a notable shift, Sandy. Lindsay advises agents to price homes with a strategic cushion. For instance, if a home is valued at $850,000, listing it at $890,000 allows room for negotiation. However, he warns against listing an $810,000 home at $890,000, as that's not strategy, but denial.
Indeed, Steve. He analyzes a specific townhome in Durham, noting that its lack of a third bedroom and bathroom, along with minimal renovations, places its value between $620,000 and $630,000. This kind of detailed assessment is crucial for accurate pricing.
And it's not just about the numbers, Sandy. Lindsay points out that high demand areas will naturally outperform averages. However, he warns that many homes fail to sell because of classic human nature, overestimating value based on hearsay rather than facts.
Lindsay's insights are a reminder that the strategies from the hyper-competitive seller's market of 2021 won't work today. He stresses the importance of adapting to a balanced market where informed pricing is key to successful sales.
Absolutely, Sandy. As Lindsay concludes, pricing should be grounded in reality. The market punishes those who defy gravity, and agents must rely on data-driven strategies to navigate this balanced market effectively.
Let's talk about the challenges move-up buyers are facing in the current housing market. It's a tough situation for those looking to upgrade to a bigger property, but finding it difficult to sell their current homes.
Absolutely, Sandy. The market slowdown has left many move-up buyers in a difficult position. These individuals are often caught in a limbo, unable to make the leap to a larger home because they cannot sell their existing property.
And it's not just about the inability to sell, Steve. Many sellers haven't adjusted their expectations post-pandemic. As Sharon Davis from DLC Producers West Financial pointed out, there's a mindset shift needed. People are still hoping to sell high and buy low, which isn't always realistic in today's market.
That's a great point, Sandy. Davis highlighted that selling at a lower price and buying low can actually be more beneficial in the long run. It may involve taking a hit initially, but the spread between selling low and buying low can work in favor of these buyers.
Exactly, Steve. The Vancouver housing market, for instance, has seen a significant cooling off. October sales were down 14.5% from the 10-year seasonal average, and active inventory has increased significantly. It's a different landscape from the pandemic-era boom.
And those who bought during the pandemic are finding it particularly challenging to adjust. Many paid high prices during the peak and are now reluctant to sell for less. But as Davis mentioned, the properties they want to move into are also priced lower than during the pandemic, which requires a mental reset.
It's a tough pill to swallow, but it's necessary for those looking to move up. The Canadian Real Estate Association forecasts that prices in British Columbia will slip by 3.1% this year, with only a modest recovery expected in 2026. So, waiting for a significant price rebound might not be a viable strategy.
Indeed, Sandy. Even though home buying activity is expected to pick up, it won't necessarily translate into a sharp increase in prices. Davis suggests that move-up buyers focus on the timing and the spread rather than waiting for perfect conditions.
Yes, Steve. For younger buyers with time on their side, making the move now, even at a loss, could be beneficial in the long run. It's all about strategic timing and understanding the market dynamics.
Absolutely, Sandy. It's crucial for buyers and sellers alike to adapt to the current market conditions and make informed decisions. The housing market may be stalled for now, but with the right mindset and strategy, there are still opportunities to be seized. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.